Look, if you are over 50, clearing more than 150 grand a year, and assuming your traditional 401k is going to shield you from the IRS this year, I have some bad news. You are walking straight into a compliance trap. For years, every financial guru on your feed gave you the exact same advice. Just max out your pre-tax catch-up contributions to instantly knock yourself down a tax bracket. Well, those days are officially over. That corporate grace period the government handed out to let companies fix their software, it is gone. The IRS just went live with one of the most aggressive tax shake-ups for high earners we have seen in a decade. It was buried deep inside the Secure Act 2.0, and it completely rewrites how you save for retirement. Now, let us get the legal housekeeping out of the way. This breakdown is strictly for educational, broad informational purposes. I am not your personal CPA. Since these overhauls hit differently depending on your exact W-2, you need to run this by your own numbers professional. But today, we're going over the exact no BS blueprint that savvy savers are using to handle this mess legally. Let us look at the actual math. To see how this plays out in the real world, let us look at a guy named David. David is 52, works as a senior software engineer, and had an incredible year. His W-2 hit $165,000. Now, his game plan for this year was simple, predictable, and honestly, pretty smart. Max out his base, 401k, and then tack on the standard $8,000 catch-up contribution, because he is over 50. He wanted to trim his taxable income and keep his cash out of the government's hands. Simple, right? First week of January, he logs into his corporate employee portal to change his deferral percentages. But instead of a green check mark, his request gets bounced back with a system error. 2 days later, an internal email hits his inbox from HR. The memo basically said that due to new federal regulations, high-income employees can't do pre-tax catch-ups anymore. But it gets worse, because David's company uses an older, off-the-shelf payroll provider that hasn't built out Roth 401k options yet. David was completely locked out of making any catch-up contributions for the entire calendar year. None. Zero. Just like that, his plan to defer thousands of dollars from his tax bill evaporated. He didn't do anything wrong. He just got caught on the wrong side of a massive compliance transition. And honestly, this is the exact same surprise thousands of high earners are running into right now. Let us look at the underlying tax codes driving this chaos. Look, this isn't some temporary glitch, and your HR department didn't just make it up. This is the full rollout of Section 603 of the Secure Act 2.0. It alters Internal Revenue Code, Section 414V. Now, if you have been researching this online, you have probably seen old articles saying this rule got pushed back. They are technically right. It did. The IRS put out Notice 2362, which gave corporate payroll systems a 2-year transition period to fix their software. But that free pass expired on December 31st. We are officially in full enforcement mode right now under the updated rules of IRS Notice 2567. Let us look at the actual numbers for this tax year. Your base contribution limit is up to $24,500. That is your standard elective deferral. Anyone, no matter how old they are, can put that money into a regular traditional pre-tax account, assuming your plan allows it. If you are between 50 and 59, your standard catch-up limit is $8,000. And if you hit that specific sweet spot between 60 and 63, the law gives you an enhanced super catch-up cap of $11,250. But here is where the high earner rule completely steals your flexibility. The law states that if your wages from your current employer in the prior calendar year crossed $150,000, you lose the right to make pre-tax catch-up contributions. Period. You are forced into a Roth. Now, pay close attention to how the IRS counts that income. The internet is flooded with blogs saying this is based on your gross salary or adjusted gross income. That is flat wrong. The legal text explicitly ties this to your FICA wages. That means the IRS checks exactly one spot, box 3 of your prior year W-2. If box 3 shows even $1 over $150,000, you are locked into the Roth mandate. And here is the administrative trap that caught David, and it might be waiting for you too. Section 603 contains a strict all-or-nothing clause. It dictates that if a high earner is required to put their catch-ups into a Roth, but the company's plan doesn't offer a Roth option, then no one in that entire company making over $150,000 is allowed to make any catch-up contributions at all. The IRS doesn't give you a pre-tax fallback option. If your employer lacks a Roth tier, your catch-up allowance drops to zero instantly. However, there is a carve-out that online influencers completely look past. Because the tax code links the income threshold directly to W-2 FICA wages, people who are partners in a partnership, LLC, members with self-employment income, or sole proprietors are completely exempt from this mandatory Roth rule. Even if they make $1 million a year, their income doesn't show up on a W-2 Box 3. So they can legally keep making 100% pre-tax catch-up contributions under the old rules. But if you are a standard corporate W-2 professional, you don't have that out. So how do you handle this cleanly? Let us lay out the step-by-step strategy. If you are stuck in David's situation, you don't just sit there and accept a higher tax bill, you pivot. There is a clean, legal tax avoidance framework you can use to navigate around these system limitations. First move, go ahead and max out your base pre-tax contribution right up to the legal cap of $24,500. This first tier isn't touched by the new FICA wage rule at all. Even if you make $500,000 as a W-2 worker, you retain the absolute right to put that first $24,500 into a traditional pre-tax account to lower your current adjusted gross income. Tell your payroll department to fill that bucket up first. Next, your path splits based on what your employer's plan allows. If your company actually has a Roth 401k option, your fix is easy. You just instruct payroll to route your $8,000 or $11,250 catch-up dollars directly into that designated Roth account. Sure, you don't get an immediate tax deduction today, but that money will compound and grow completely tax-free for the rest of your life. But what if your company is behind the times like David's, cutting your catch-up allowance to zero? This is where you walk out of your company's sandbox entirely. You handle this by executing a clean backdoor Roth IRA through an external private brokerage account. This lets you work around your employer's plan limitations by utilizing individual accounts. For this tax year, the individual IRA contribution limit is $7,500. And since you are over 50, you get a personal catch-up allowance of another $1,100. That gives you $8,600 total to funnel into the system. Since your high income blocks you from contributing straight to a Roth IRA, you put that cash into a standard, non-deductible, traditional IRA. First, wait a couple of days for the funds to settle, and then immediately convert it over to a designated Roth IRA. But wait, here is the part standard financial blogs completely omit, and it will cost you a fortune in unexpected tax penalties if you aren't careful. If you have old rollover IRAs or pre-tax traditional balances sitting in an old brokerage account somewhere, the IRS hits you with the pro rata rule. They view all of your separate IRAs as one single pool of money, and they will tax your backdoor conversion proportionally based on your pre-tax versus post-tax mix. To dodge this trap legally, you need to use a strategy wealth managers call a reverse rollover. Before you even attempt a backdoor Roth conversion, you take those old pre-tax IRA balances and roll them back into your current employer's active 401k plan. Because employer-sponsored plans are completely left out of the IRS pro rata calculation, this clears your personal IRA deck down to exactly $0, letting you execute your annual backdoor Roth conversion completely tax-free. That is how you claw back your retirement velocity. But look, doing this requires real operational precision. One simple mistake and you trip an automated IRS flag. Let us talk about those audit triggers. Look, we have entered a phase where the IRS is letting automated algorithms do the heavy lifting, and they are explicitly hunting for high-earning professionals because, frankly, That's where the easiest tax corrections are made. Under the current system, compliance mistakes on your catch-up contributions are caught automatically. No human agent even needs to look at your file. Think about how basic the math is for an IRS computer. Your company files your W-2. The system checks box 3 for your Social Security wages. If that number reads $150,001, the algorithm instantly jumps down to box 12 to see how your elective deferrals were categorized. If it sees that you made pre-tax catch-up contributions while crossing that income line, the system instantly flags a cross-referencing mismatch. What happens next is a massive administrative headache. The IRS won't just politely ask for the money back. They will force your employer to issue a retroactive amended W-2. That excess pre-tax contribution gets kicked back to you as ordinary taxable income. And if you don't get it sorted out before the April filing deadline, you face a double taxation penalty on excess deferrals under IRC Section 4. In really bad corporate scenarios, an employer's failure to enforce these Roth rules can actually threaten the tax-qualified status of the entire company retirement plan. It causes operational chaos for everyone involved. But look, don't let the fear of an audit paralyze your planning. The secret to staying completely clean is making sure your payroll deductions are categorized correctly from day one. You never want to manually fiddle with your W-2 numbers or try to hide active income streams. If you run a side business or an LLC alongside your main corporate job, don't just assume your business can automatically absorb these catch-up limits without bumping into the total annual addition caps under Section 415C. Your total aggregate limits across all plans need to be watched closely by a pro. Let us map out your exact next steps. Look, managing your wealth in your peak earning years isn't about chasing magic loopholes or tricks to beat the taxman. It's simply about knowing the boundaries of the current code and adjusting your accounts to match. The Roth catch-up mandate is live, and ignoring it is just going to cost you time, momentum, and money. Here is the bottom line play. Book a quick meeting with your CPA or financial professional and lay these exact 4 questions on the table. First, did my final prior year W-2 Box 3 FICA wages officially clear the $150,000 mark? Second, does our company's current 401k setup actively support designated Roth catch-up contributions right now? Third, do I have old rollover or traditional IRA balances sitting around that will screw up the pro rata calculations if I have to use an external backdoor Roth strategy? And fourth, can we initiate a clean reverse rollover to shield my existing pre-tax retirement assets from unnecessary tax friction? If you want to read through the raw IRS notices and tax updates yourself, I've dropped the direct links to the official government source pages down in the description below. Protect what you've earned, execute your plan with absolute precision, and hit subscribe to keep your wealth strategy dialed in. We'll see you in the next breakdown.